Hello everyone, and welcome to this week's CLiK Trading Education Market Breakdown. This is your structured, process-driven overview of global markets for the week ending 20th February 2026. As always, this is not about prediction, it's about understanding positioning, rotation, risk, and structure. Let's break it down properly. Let's start with the big picture. Equities were broadly positive this week. The S&P gained just over 1%. The Nasdaq led again, up 1.16%. The FTSE was the standout, up 2.6%. Now look at commodities. Silver exploded higher, up over 9%. Crude oil gained nearly 5%. Gold continued grinding upward. Meanwhile, the US dollar strengthened. Bitcoin pulled back slightly, and the VIX volatility dropped sharply by over 12%. That drop in volatility tells us something important. This was not a panic-driven week. It was controlled rotation. In the US, markets were balancing two narratives. On one side, strong earnings from major tech names, Amazon, Alphabet, Nvidia, reinforcing the AI growth theme. On the other side, sticky inflation data, which suggests the Federal Reserve may delay rate cuts. So what happened? Yields stabilized, volatility collapsed, equities pushed higher, but not aggressively. This is what we call risk on stabilization. Important lesson here, a falling VIX doesn't mean risk has disappeared. It often means complacency is building, and complacency can unwind quickly. The FTSE outperformed this week. Why? Because it's heavy in energy and mining stocks. Oil rose, metals rose. That directly benefits FTSE components like BP, Shell, and Rio Tinto. Now look at sterling. GBP USD fell over 1%. Why? The US dollar strengthened and the Bank of England remains cautious. When GBP weakens, it actually helps multinational companies in the FTSE because overseas earnings convert back into stronger pounds. That's a good example of how currency and equity markets interact. Commodities were the most dynamic area this week. Silver surged over 9%. That's not a quiet move. That's momentum expansion. When silver outperforms gold like this, it often signals speculative participation, not just defensive safe haven buying. Crude oil climbed nearly 5%. Drivers, OPEC supply discipline, Middle East shipping risk headlines, geopolitical premium. Gold continued to grind higher, not explosive, but steady accumulation. When you see the metals and oil rising together, that's often inflation-sensitive positioning. The dollar index strengthened again this week. This wasn't fear-driven strength, it was yield-driven. USD JPY pushed toward 155, which is historically sensitive for Bank of Japan intervention. That's a level traders need to treat carefully. The euro and pound both fell. Aussie was notably weak. When the dollar strengthens in a low volatility environment, it usually reflects policy divergence rather than panic. Context matters. Bitcoin pulled back slightly. Ethereum was flat. Altcoins softened. What does this tell us? Risk appetite is selective, not broad. Earlier, ETF-driven inflows boosted crypto. Now we're seeing consolidation. Volume compression plus price compression usually means the market is waiting for a catalyst, range-bound behavior until something shifts. Now zooming out, markets are increasingly influenced by political positioning, US-China trade rhetoric, Middle East shipping risk, US election fiscal debates, and European growth revisions. Remember, markets don't price headlines, they price expectations. The real question is what changed? Was it already priced in? That mindset separates reaction from analysis. Technology leadership remains intact. Amazon, Alphabet, Nvidia, all strong. Palantir continues benefiting from AI government contracts. Microsoft saw slight profit taking. Tesla remains mixed. The important distinction, capital is flowing into companies with proven AI revenue impact, not speculative hype. That's healthier. Selective rotation is constructive. Broad mania is dangerous. This is not mania. Technically speaking, the S&P remains in an uptrend. The Nasdaq is still leading. Small caps are positive but lagging. Commodities are expanding momentum. The VIX collapsing to 19 confirms stability for now, but compressed volatility often precedes expansion. Low volatility environments can reverse quickly. Always define your risk before entering. Next week is data heavy. US core PCE inflation, very important. Durable goods, consumer confidence. In Europe, flash CPI. In the UK, GDP revisions. In Japan, inflation and possible commentary if the JPY rises further. For Oil Watch, EIA inventories and OPEC comments. These events can trigger volatility expansion. Plan before the event, not during it. Here's the most important part. We do not predict, we structure. We ask, where is price relative to higher timeframe supply and demand? Is volatility expanding or contracting? Is this risk on or risk off? Do multiple factors align? That's probability stacking. This week showed controlled risk appetite, commodity rotation, dollar firmness, tech leadership intact, structure, not opinion. Silver's explosive move increases pullback probability. USD, JPY near intervention sensitivity. Volatility compressed, expansion risk rising. Oil strength tied to geopolitical premium. Always define entry, stop, position size, risk percentage, no exceptions. That's professional trading. This wasn't a dramatic week, it was structural. Structural weeks are where professionals build consistency. No panic, no chaos, just methodical capital rotation. Amateurs wait for drama. Professionals build edge in quiet markets. Stay process driven, stay measured. Trade what you see, not what you hope. I am Ifti and thank you for watching. If you found this helpful, share it with another trader who values structure over hype. This is CLiK Trading Education. Real traders, real structure, real risk management. And as always, this is educational content only. Trading involves risk. See you next week.